Hi, so this is the tax multiplier video. Hopefully you've done the spending multiplier stuff first and the tax multiplier. Most people think it's a little bit more complicated, so I feel like doing the spending multiplier first is nice, and then you can build from here. So we're going to see that this is eerily close to the spending multiplier with a few nuances that make it different. So again, this is all about fiscal policy or a change in anything in the C plus IG, G plus XN aggregate demand category. But taxing has to come from the government. So this would be how the taxing is going to be government policy, and then that is going to then impact the way that consumers and businesses spend money because it's going to affect their disposable income. So basically, when you change taxes, you then manipulate how much money people have to spend, and then you're impacting the spending in the economy. So these two are pretty closely related. So let's go with the same type of scenario we did before. Let's say the economy is in a recession. How will a change in spending close the gap and bring the nation to full employment? Now remember, this is spending caused by tax changes. So it's really a change in taxing. So you have to think about it as taxing then impacts spending. So again, they're very similar, but we're given different information. Okay, so what info do you need? Just like with the spending multiplier, you need to know a country's MPC or the MPS. Remember what I told you before. You're most often going to be given the MPC and the MPS, and then you're going to have to solve for the MPC. So they like to give you two steps. You're going to need to know the size of the recessionary gap or how much the government is going to change in taxes. And there's FRQs and multiple choice questions out there where we can look at them and we can see the different ways in which you're either given like the change in taxes or the change in GDP or the different size of the recessionary gap. And basically, they're all getting at one big idea. And again, little coaching tip here. Government spending will always have a greater impact on GDP, than taxing. And you might be saying, well, how can you be sure? Because people save part of their disposable income. So if I got a tax cut and I was now making $100 more a check, and I lived in an economy where the marginal propensity to save was 0.2, I would be saving about $20 of that newfound $100 in my income. And that $20 would not be multiplied in the economy. So what we have to understand is that spending is always going to impact the economy more than taxing because 100% of the government spending is going into the GDP. You know, if the government hires a firm to do a job for them, for example, design a bridge, and they pay $1 million for that bridge to be built, the designers, the architects, et cetera, 100% of that money is going into the economy. Whereas if we give $1 million tax cut, 20% of that tax cut is going to be saved by consumers and it's not going to be spent. This is a common thing that comes up. And when we do some of the FRQs and multiple choice questions, you're going to see that. So how do you determine the tax multiplier? Well, you have two options. The first option, I think, is the better option, which is to continue to practice your ability to calculate the spending multiplier. And then because people either spend or save all of their income, the spending multiplier and the tax multiplier add up to 1. Remember, how much we spend and how much we save adds up to 100% of our income. So if all of the country's income is either spent or taxed, basically those are going to add up to 1 as well. So if the spending multiplier in our last scenario was 5, what plus 5 equals 1? A -4. So here's another little bit of information for you to take away from this as well, is that the tax multiplier is most often a negative number. Because if it adds up to 1, it has to be negative because the spending multiplier is going to be a positive number. And I don't think it takes a mathematical genius to figure that out, but I've done this a lot. So I've practiced that and I've kind of internalized that rule. So like I said before, what way do I recommend? I recommend not learning another formula because you have a lot to learn. So I just think solve for your spending multiplier and then determine the tax multiplier, knowing that they add up to 1. So if your spending multiplier was 8, then your tax multiplier is -7. If your spending multiplier is 10, then your tax multiplier is -9. I just think it makes it easy. But you might be somebody that says, well, I can take out another formula. So here's your other formula. You take the MPC, the negative of that number. So if your MPC is a 0.8, you're going to take a -0.8. And if your MPS is 0.2, because again, they add up to 1, you're going to take a -0.8 divided by a -0.2, and that equals a -4. So you're going to come out with the same number in the end, either way. But again, I think it's nice to be able to not have to memorize another formula, because what if you mix this up? What if you're like, ooh, I forget if it's the marginal propensity to consume on the top or the bottom? I mean, you could do it and double check it, but then you're always going to have to go back to here. So my recommendation is just remember that they add up to 1, but then you also have this other option to kind of double check, or, you know, if you're forgetting this detail, then you have another tool in the box that you can use. Okay, so then what? You're going to plug that -4 into this change in GDP. Okay, so let's say you needed to change the GDP, or the change in GDP was $200 billion. Okay, so here you are, you realize that the recessionary gap, you're a policymaker, and you recognize that there is $200 billion of GDP that is the space between where your economy is and where you want it to be. So you want to push the economy into a growth direction. You want people to spend money, you want businesses to spend money, and you want the economy to grow. So you're going to do the change in GDP equals the tax multiplier times the change in taxes. So the tax multiplier was a -4. The question is, how much do I need to change taxes to get to a positive of $200 billion? Well, I hope that you remember that when we multiply numbers, a negative times a negative equals a positive number. So we're actually going to be looking for a negative number for the tax change. So a -4 to equal 200 billion. If I take this 200 billion and if I divide it by 4, okay, what times 4 is 200 billion? 50. So I need to have a -50 times the 4. So you might be asking yourself, well, what do you mean a -50? If this is a negative number in front of the 50, that means that I need to cut taxes by $50 billion in order, all right? And what I should do is put a little billion in here and a $sign. But what I need to do is cut the taxes. So if you think about it, if we cut taxes, that's going to give people more disposable income. They will then be able to spend that income. So that makes sense that that would grow the economy. But remember, they're only going to spend in this economy that we've set ourselves up with, they're only going to spend 80% of what they've been given in their tax cut, because the marginal propensity to consume in this country is 0.8. So if you wanted to grow the economy,